Welcome to Season 2, Episode 4 of Aveco Economic Forum. I'm Akash Subramanian, your host for today. And today we are starting a very new segment under Aveco Economic, which is company analysis. Now, we often realize students do not really know how to invest in stocks by just analyzing a company's performance. They go on their teacher's review or from their friend's review and just go ahead and invest in a stock. So, here we'll be covering a base ground as to how you can analyze a company, look at their financials, look at their general operations, and then learn how to invest in them. So today we are covering a very interesting company, which is Clean Science and Technologies Limited, which has been in the news recently because of their IPO launch, which was hugely successful, and they've been doing very well in the last few months in the stock market. So let us look into the company, what we'll be covering in this analysis. The first Indian economic overview of the chemical sector, worldview of the stock market in a very brief analysis. Then we'll be going on to the company, their manufacturing unit, how they do the operations, then about their competitive position, their financials, their future prospects, etc. It'll be a fun session. We have very interesting speakers today, two new speakers with us. We have Bryan John here, who is currently pursuing his MBA in finance in NMMS College. We have Abhijeet Dwivedi, who's pursuing his telecommunication engineering in Somaya College. And we have Bharat Kulkarni, who is currently pursuing his chartered accountancy. So, best of luck, guys. Let's go ahead.
Okay, so first of all, the main thing is the burnout which has happened in the stock markets of chemical industry. So what has happened is basically many companies have been overvalued in the pandemic situation because of the inflow of cashes, and which has given rise to inflation, which leads to the stock markets reaching their peak, and hence it has been caused kind of a burnout in the stock markets, wherein
So India's chemical supply chain strategy. So India's chemical supply chain is a robust growth trajectory. It is increasing over the years, and what has led to the increase is mainly factors in the rapid policy changes and regulatory environment which the government is providing. Not only that, it is because of the cost-effective manpower and many such factors like the potential China plus one strategy. Also, India's chemical industry contributes 7% of the country's GDP, which is a large number, and the value of the Indian chemical industry is $100 billion in 2019, but it is expected to rise to 300 billion in 2025. So that is a huge growth. Yeah, and rise in demand from end user industries is expected to showcase 18 to 23% revenue growth in this coming financial year. And the production volume of chemicals has stood at 9,35,513 metric tons in August 2021 and is increasing continuously.
All right, fascinating figures provided by you, Brian, definitely. And now we understand the importance of chemical industry, especially in the pandemic. We have seen sector chemicals and pharmaceuticals and fertilizers rise so much. It was because the demand for them, the importance of them was realized, and then we went ahead and try to invest more in these companies, get to know more about them. Domestic and as well as foreign institutional investors have been very active there. So before we move on to the company itself, just a little bit of the industry growth.
So Akash, talking about the industry growth, I would say that in the recent years, the industry of chemical manufacturing has been seeing multi-bagger growth because the Western superpowers and other countries throughout the world have realized the importance of China plus one strategy. In 2020, we have seen the disruptions in supply chain globally because of China's international political aggression and obviously the COVID-19. We have seen that the importance of Indian chemical manufacturers has increased globally. That is the reason, as Brian said, that the industry is estimated to grow at the pace of 18 to 23% and to reach at the milestone of $300 billion by the year 2025. So that definitely affects what is happening in the domestic chemical manufacturers. Also, the company which we are covering today, that is Clean Science, is a green chemical manufacturing company, which is also fascinating number of $45 billion expectations by year 2025, and it provides the decent growth rate of 10.5%. Also, if we see the kinds of products which the Clean Science manufactures, we can see that the products in themselves provide a good uh, CAGR growth. In that, we could see the performance chemicals, pharmaceutical intermediaries, FMCG growing at the pace of 8 to 12% annually. So that is decent growth. When investor considers the asset allocation, these growths can actually affect the decision making of the investors.
All right, definitely a wonderful insights given to the industry, and also now we also got to know about CST and how it has, what kind of products it has. A little more insights into Clean Science and Technology about the company. As mentioned, it's a chemical manufacturing company, which means it's a B2B kind of company which caters to many pharmaceutical companies, many who are indulged in chemical lab manufacturing units, etc. So it is not only machinery, it is chemical compounds, it is material handling, etc., which Clean Science and Technology handles, but mainly it's a B2B company. As mentioned, three sectors that they work in towards API, which is for the production of pharmaceutical medicines, etc., for performance medicals, and MEHQ, which is a chemical compound which is used for household materials and household
Yes.
chemicals. So that is where it is involved. Their manufacturing facilities is within India itself. Kurukum is, I think, that's the place where.
Kurkum is basically one of the top areas which Indian chemical manufacturers prefer. In recent times, I have come up with many companies like Clean Science is there, Alkyl Amines is there, Deepak Nitrite. Many companies prefer Kurkum, and one more, Patal Ganga, as the place of manufacturer. The reason being is these places are very close to the port. That is the JNPT port, from which the major supply of major import export, basically trade of chemicals, happen internationally. So these are very strategic locations, and this also provides a competitive edge over the other players. So it's actually a good point to cover.
All right, makes perfect sense. And yes, the hub of chemical manufacturing is where even CST is based right now. So before we move ahead along with our PPT, I'll move on to a small aspect called the China factor before we go to the company's website and try to get more insights into their financials. The China factor is basically India's dependence on China, especially for chemical compounds, for pharmaceuticals, etc. We've always had a negative net exports, because we depend on China for even the smallest of materials like paracetamol for crocin or for Dolo, etc. Because it is very cheap to be manufactured and to be supplied from China, local production is very expensive. So in this era where we're trying to reduce our dependence on China, pharmaceutical and chemical take a small hit because of the dependence. However, Clean Science and Technology is such a company which has its export operations with China too. However, their net exports has seen a positive growth, which is very rare for such companies in this sector. It's a very good pointer for Clean Science, and it is a definite growth measurement aspect, because with China, most of the companies have a negative net export.
Also, Akash, I would like to add that in the recent years, Clean Science has witnessed that it has reduced the sales dependency on China also. So they have diversified their portfolio, they have diversified their customer relations, so that the China factor is quite hedged from their side.
True that. Yeah. Wonderful point. So now you are trying to get the insights into why CST and why it's so much prominent right now. So let us go into the Zerodha website and get to know more about the company. All right, so we have come to the Zerodha's website, and we can see their market price per share of the last 1 year. We can see where they were right in the start of July, probably last year, July 19, around 1,585. I think around November is when Clean Science had launched their IPO. So when I go to November, it's 2124. So right here was, due to the pandemic factor and due to importance of chemicals coming in, we saw the rise from September to October with the news of their IPO coming in. And since then, it has always been a growth for them. It's been, positive CST for them. Towards the end, you can see a small dip in their prices. That is because of the overvaluation of the market, the correction factor coming in, and then we could see the changes happening. Now, going ahead to their key metrics, we can see a few ratios here. The PE ratio is about 130.31. The calculation depends on the MPS and the EPS. The division gives us the P ratio. Now, PE ratio, when I'm comparing it to the sectoral P ratio that we see here, it's 25.66, whereas our company has 130.31, which means that growth aspect in terms of, in a particular chemical industry itself is already being exposed enough by this company. The company has started its operations since 2003, which means it has covered a very wide aspect and has been into many operations, and hence growth regarding PE is less. So this is not a very good factor considering investing in the company. However, since it's recently launched IPO and recently been listed, moreover the importance of the pandemic and chemical industry being on the growth, the company can yet be expected to increase its operations and revenue. So this does not really affect the company's performance in total, but definitely affects their expansion and current economic activities. Then we can see the PB ratio, again, due to the same factors, PB ratio is more than sectoral PB. And so this was more about the ratios. Debt to equity, as per my knowledge, it is less than 1:1, which means it's a good factor. Any company having a debt to ratio less than 2.5:1 is considered to be really good. So even that does not affect not investing in the company. Going ahead to analyze their peers.
So in the recent times, the chemical industry is actually been highly competitive in terms of investment sense, because if I tell you to invest in chemical companies, you are definitely going to see the options which all are available to you, and from them which one you find the best, obviously you are going to select that. So in terms of investment, I would say that there are other factors, other companies which are indulging in same industry, and they are mainly Aarti Industries is there, Gujarat Fluorochemicals is there, Vinti Organics, Deepak Nitrite, Alkyl Amines, GMM Pfaudler, and many more are there. But still, in the sense, if I compare some of them, I would say that Clean Science and Technology has much higher PE ratio as compared to others. Price to book value is more obviously in terms of their steep rise in price in last few months, and obviously dividend yield is also somehow more. We will also talk about dividend yield further in our financial ratios discussion, as the yield of 1.03% is not giving a very clear picture as such.
So after looking at peers, before we move on to more financial projections and their holding, a part that we would like to cover is the compounded annual growth rate of the company and how it has been affected towards the company. So Abhijeet, if you would want to take that up.
Yeah, sure. Thank you. So PATA, PAT and CAGR. So what is PAT? PAT stands for profit after tax. It is the revenue minus expenses and taxes. So whatever remains after subtracting the expenses and taxes from the revenue is PAT. And CAGR, what is CAGR? CAGR is compounded annual growth rate, which is indicated in percentage. It is the mean annual growth rate of an investment over a specified period of the time, usually longer than 1 year. So if we see from the chart, then the company has demonstrated a great performance in the 3-year PATA CAGR chart. As we can see in the third right chart, where you can see a good increase of 42.53%. That is to 198 crores from 139 crores year on year. And also, if you have a close look on EBITDA margin of FY21 with a return in equity of 36.76%, it has been among the best in the chemical industry. Also, the CAGR increase of 14% has also been exemplary. Yeah, thank you.
Right. So that shows another very big aspect as to how CST has been doing so good. The annual growth rate, especially in the last 3 to 4 years, has been impressive. All right. So Varad, over to you to analyze the financial holdings for this company.
Yes, Akash. So basically, from the screen, we can see that the total promoter holding which is there, you can actually select the shareholder history as promoters. During the FY 2021, initially promoter holding was 94.65, which is a huge number in itself. And the decrease in promoter holding is because of the latest SEBI regulations which came up in the market, resulting which in the many companies where promoter holdings were more than 90% of total equity, they had to dilute their stake and bring it to 75%. So in the coming future, we can see more dilution in stake of promoters to 75%. We have seen the similar case in case of Avenue Supermarkets, that is DMart also, where promoters have reduced their stake prominently. If Akash, you select the retail category in shareholding history, retail and others, then we can see that in the retail category, the holding has increased during the July period, that which we saw on the price chart, which was the peak of the Clean Science and Technologies. After that, we have seen the retail holding has quite reduced, but that also doesn't bother me, because the price, when it is usually seen that when the market falls, the retail investors generally flee out of market, and then FIIs, DIs, and mutual funds enter the market, which is also led by banks and insurance companies in India, which are called as domestic institutional investors also. So that's the main story about the holding pattern, which is quite justified in my opinion, because promoter holdings is as per SEBI norms, and it is quite maintained also. In case of mutual funds also, it is not fluctuating too much. So I guess in terms of shareholding pattern, it is quite justified.
That is right. So as you mentioned, even for Avenue Supermarts, most of the promoter holding almost, they used to have at least 84%. Right now, I think the starting of 2021, they had divested a few shares, so it became 78%, similar to Clean Science and Technology.
Yes, that also actually result in increasing in free float in the market, which
Yes.
in turns increases the price volatility. If you see that, then the beta factor, which is the volatility factor of Clean Science, is 3.07% of Nifty. So when the promoter holdings dilute and number of free shares available in the market for trading increase, the beta factor in terms starts increasing. So that's also one factor we should be considering, and that's not a concern of worry as long as industry is performing well and companies generating healthy cash flows.
True that. So after seeing the company's holdings, right now, just towards the final aspect of our analysis, most important part, which is the income statement of the company, the balance sheet, and the cash flows.
So the income statement basically tells us about the profit and loss about the company and the financial performance of the company over a period of time. So total revenue, as you can see, over the last 4 years, it has increased from 245.6762 crores to 538 crores, which has increased a lot. And talking about the EPS, which is the earnings per share, it has increased from 4.32 to 18.68, which is a 5 times increase over the last 4 years. And talking about moving on to the EBITDA, so the EBITDA has also increased from 78.41 to 284.83. And mainly this EBITDA has increased because of the anisole background integration, which is related to the pharma company of Clean Science, and the vapor phase technology which they have implemented. So rest of the parts like PBIT, PBT, and net income have also increased, which is overall. So the overall income statement clearly shows that it is a great income statement, and it is consistently increasing over the years.
That is right. Coming back to the focus of DPS being increasing so drastically in the last financial year was because the company believed in what it was providing to its B2B customers than what the investors could provide to the company's value. And hence, they changed their perspective, they changed their operation mode in 2021. They went more futuristic towards their own approach towards the market. And hence, we had this increase in DPS.
Yeah.
So after analyzing the income statement, we can move on to the cash flow before we come to the balance sheet. So, Bharat, over to you.
Yes, Akash. So, in terms of all the companies, cash flows is one of the important factors because you have to be solvent to meet your future obligations, your current obligations, as well as if you're having free cash flows, then you have freedom to select the projects which you want to pursue and which can add the value to your shareholders in the future. So, if we talk about clean science and technologies, then we can see that capital expenditure during the last 4 years has gone up significantly. We can also see its effect in the property, plant, and equipment section, that is fixed asset section in the balance sheet, which has increased in terms of capital expenditure. So, basically, in free cash flows, if we talk about, then it has increased from 12.96 crores to 108.43, which is almost 9 times increase in free cash flows. Free cash flows are basically, it is a mathematical term, which is net profit after tax divided by your cost of capital. If we further analyze the free cash flows approach, then we can say that it is more of a number game. If I say that the company's cost of capital has decreased in the last few years, or I can also say that the net profit after tax has been growing. As Bryan, explained in our previous slides, that the net operating margins have also increased significantly. That is almost 4 to 5 times during the last 4 years. We can see that the free cash flows have been affected, and which is also accompanied by the decrease in cost of capital of the company. The equity to debt ratio of the company is almost zero. They have been reducing the amount of debt in the company. So that is definitely an indicator of reduction in their cost of capital, which is a positive sign for the company.
So, moving on to the cash flow statement, now if we come to the balance sheet analysis, there are a few aspects that we can focus towards and see exactly where the company gains its advantages from.
Yeah.
So, a general overlook, if you see the current assets growing from 125 crores to 395.14, and if we see the total liabilities being between 48 to 120 crores, we can see the amount of difference between them, how much inventory the company has, how much time it has to actually recover from any kind of losses, etc. it has. So it can easily pay off all its liabilities in the period, and hence it's a great company for a long-term investment. Focusing more on the current assets, we have total receivables to be slightly increasing. They have more clienteles coming in. Total inventory growth to be constant. Often in pharmaceutical and chemical companies, inventory management is the most important aspect. And for some even big companies, we can see huge loss margins, especially in total inventory. However, this company has been able to keep it constant in the last 4 years, and since forever, they have been able to maintain it. Moreover, cash and short-term investments have been increasing with exponential growth going towards pharmaceutical companies, B2B growth for pharmaceutical machinery. Their investments there have been increasing and has been advantageous. Coming to the non-current asset aspect, we have goodwill and intangibles to be zero and long-term investments none. So their focus has been totally towards only the manufacturing and the supply chain aspect.
Cash flow approach, we had seen that capital expenditure has been increasing for the last 4 years consistently, which effect we can see in the property, plant, and equipments also. Actually, the company is largely focusing upon bringing vertical integration in its operations, and which is actually similar to, if I give you an example, it is like you produce a one product, and to produce another few products of your own brand, you use your own raw material. So that eventually reduces your cost, and that makes you independent of your supply chain. So that all the efficiencies have proved that the company has been able to grow its operations consistently, and the PP aspect and capital expenditure aspect, they actually go hand in hand. So as capital expenditure increases, the property, plant and equipment also increases. With this increase, we can clearly justify that the company is producing its future assets. That is, if the company starts growing its PP at this pace, companies ensuring that it has reasonable assurance to produce more future revenues also. So at the same time, at which it is producing a very healthy return on capital employed, it is also ensuring that it is producing, or it is reserving a share to its future incomes also. So that's about PPE factor.
That is true. And hence, any analytical videos that you see, often CST is termed to go for long term, because any of the strategies mentioned have always been for the long term prospects and not for short term gains. So even if we look at the current liabilities of the company right now, as I mentioned, very less compared to what they have been facing with the assets. Assets have been in a total increase. So easily any losses, any liabilities can be taken in, because even their own reserves and surplus has enough strength to hold over their losses or liabilities.
One more thing about current asset and current liabilities is that these factors are as on date. So these amounts are actually taken as on date of 31st March of respective financial year. During the year, we can see that the figures will be going way less down, or they can be more also. So actually, we can say that these figures are not very representative, but it gives us at least a fair idea of what's happening in the company.
That is right. That is right. With the IPO also coming in, definitely numbers are expected to increase from both sides, from assets as well as liabilities.
Yes.
However, the general performance for the last few years, at least till March 2021, has been as such, with the balance sheet and the income statement. Just one last aspect covering the non-current liabilities also. Total long-term debt has been one aspect, has been kept as low as possible. Only 33 lakhs is the total long-term liability. And finally, in total equity aspect, if you check this sector of minority interest.
So a company has zero minority interest in its books because it has basically 3 subsidiaries which are wholly owned subsidiaries, and since which the minority interest is zero. Minority interest basically happens due to the holding and subsidiary relation, in which if you hold 98% of the total assets of some company which is a subsidiary, then 2% is minority interest, which is the share of other people in your subsidiary. So in our case, it's all wholly owned, so it's zero.
So apart from that, if you see the reserves and surplus too, they have been kept a good stock from their revenue generation itself. They're kept for reserves and surplus for R&D, for future growth and aspects, and for operations. So again, a very sustainable business here. So this is our analysis of the total company, and this was our analysis for the company. And if you guys have any doubts, etc., definitely leave it in the chat box. Thank you so much, guys, for watching our video. If you like that analysis, do like the video, do share your comments, your suggestions, etc., in the chat box, and definitely share this video with your friends, and all of you get together and try to analyze such companies, try to gain interest in them. Definitely very interesting aspects. Until then, see you in the next video.